Go. Hello, everybody. Hopefully your break was good. As you can tell, as you may be able to tell, I'm sitting in a different conference room. Actually, in conference room 3. I will be in conference room 3, and my other speakers, my other guys that will be speaking today, will be in conference room 1. So I want to introduce my speakers. Shawn, if you can advance the slide. Again, I'm Don Johnston, partner of Grossman, Yannick, and Ford. For those of you who are just joining us, welcome to CPE Day Session 5, actually Session 6 of 8. Today, for the last hour of the day, our topic will be non-traditional tax savings strategies, opportunities, and risks. And I have with me, go back to the last slide there, Shawn. I have with me speaking today, Shawn Firster, who's a senior manager in our tax services group. Shawn does a lot of special projects with respect to research and development tax credits, so he's going to spend 12 to 15 minutes talking about R&D tax studies. David Kerin is a senior associate with our tax services group, and David will be talking about some community development type credits that are available, things that he's worked on over the last couple of years, and he's come very, very adept at working through these credits. So we thought it was a good opportunity to throw it out to our attendees. And then Michael Weber, who's the senior manager, who will be talking about sales tax related matters. After Wayfair, I know Michael talked about sales tax issues at some of our prior CPE days. So, wanted to do just a very short follow-up, talk about some sales tax things that he's been working on, things that he's seen over the last couple of years. So there you go. So first off, before I get into this, I want to make sure we give a shout out to Mary Lou. You guys that traditionally come to CPE Day, you guys all know Mary Lou. You know how ridiculously hard she works to get this day coordinated and make sure that we don't have any issues. So thank you to Mary Lou. Thank you also to Carissa. Carissa and Mary Lou work together to make sure that this thing doesn't blow up. So thank you to both of them, and most importantly, equally as important, I'd say, thank you to Glenn, who, from a technology point of view, has helped us set this thing up so we can be, doing live video and have the slides up. So thank you to those three. They've worked so ridiculously hard to make sure that this goes off. So thank you to all of them. So non-traditional tax saving strategy, and somebody just sent something from Jay Clayton to all panelists. Mary Lou is awesome. Three exclamation points. So thank you, Jay. Thank you for that. All three of them actually are awesome. They do an unbelievable job for us. So thank you, Jay. I greatly appreciate it. The only unfortunate thing that I'm going to tell you today is, and I know those of you who go to our event would agree with me, one of the best parts of CPE Day at South Point is the afternoon cookie break. And unfortunately, sitting here in Gateway Center, there's no afternoon cookie break. And one of the things that's always questionable, one of the things that always makes me consider and think, and I don't completely understand it, is we generally have 300 people attend CPE Day at the South Point Hilton Garden, and somehow 300 people can get through 900 cookies in 10 minutes. And every year we run out of cookies, and every year we have 900 cookies, and every year we only have 300 people. So when you do the math there, it kind of doesn't make sense. So obviously the cookies are thoroughly enjoyed, and I know there are some people sitting here today attending that have not come to our live event, but I think you should come to our live event when you get invited, because the cookies are quite spectacular. So let's talk about some non-traditional tax saving strategies, opportunities, and risks. So the first thing I'm going to talk about, and Shawn, you go ahead and hit the button. So let's talk the topics for the session. I'm going to talk a little bit about EITC credits, just a couple minutes, and I'm also going to talk about IC-DISC, Interest Charged Domestic International Sales Corporation. I've got one slide on that, and the reason I'm going to talk about that is because I've had some issues with some newer clients on IC-DISC, so I thought it would be important to kind of throw some things out there. Shawn's going to talk about R&D, David will talk about community development, and then Michael will finish up with sales tax update. So EITC, Pennsylvania Educational Improvement Tax Credit. Okay, so I have quite a few clients that use this educational improvement tax credit, so I wanted to talk a little bit about it just to make sure that that folks are familiar with it. So basically, educational improvement tax credit is a Pennsylvania tax credit program that allows Pennsylvania taxpayers to save up to 90% of Pennsylvania taxes based upon the amount that they contribute to a qualified educational improvement program. So basically, what you do is you apply for these loans, and then you make contributions to a charity, and that charity would allow you to take a 90% tax credit for 90% of what you contribute. So if you look at the very bottom of this slide, just as an example, a $10,000 contribution would save you $9,000 of Pennsylvania tax, and then you'd be able to take you may be able to take a charitable contribution for $1,000 on your federal tax return, which means that it costs you out of pocket $630 to make a $10,000 contribution to the school of your choice. Now you can see the 3 bullet points there: scholarship organizations, educational improvement organizations, and pre-kindergarten scholarship organizations. And if you click those links, which you should be able just to click those links, and it'll pull you right up to those organizations. It has a list of those organizations that qualify for these tax credits. The problem with these tax credits is you have to apply in advance to get these tax credits. Go ahead and shift, Shawn. So you have to qualify in advance. So a couple qualifying requirements here is you have to have some type of Pennsylvania sourced income to qualify, but you don't have to have a lot of Pennsylvania sourced income. You can actually have just a couple $100s of Pennsylvania sourced income, and if you have Pennsylvania sourced income, you can still qualify for a significant amount of credits. And the credits can be way more than just your Pennsylvania, because you might have a situation where you work for a company that's not headquartered in Pennsylvania. That income wouldn't qualify. In that situation, you have to find some other type of Pennsylvania sourced income to qualify for these EITCs. The easiest way to qualify for these ETCs is through what's called a special purpose entity. So there are a couple different ways to do it. You can qualify the old way, but it rarely works because most of the money is generally gone. The state of Pennsylvania sets the money aside in these accounts, in the educational improvement account, and once that money is gone, it's gone. And what we've found over the last couple of years are the special purpose entities are grabbing most of that money right out, pretty early. So that money disappears before most investors or contributors doing it the old way, i.e. applying through your business, would be able to qualify for the EITC money. So just to summarize it real quick, excuse me, you contribute money to a school or an SPE, you get up to a 93% tax credit. So the question is, when does this apply and when should I do this? Well, if you are already giving money, go ahead and flick, Shawn. If you're already giving money to one of these schools, like for example, let me give you a good example. I have a client that I picked up a couple years ago, brand new individual client. And when I met with him to review his tax return, I noticed that he was giving $30,000 a year to one of these schools. So I assumed, excuse me, I assumed that he was using EITC, but I later found out he wasn't using EITC. So he was already contributing $30,000 to the EITC or to this particular school. I set him up through an SPE to contribute that same amount of money into an SPE, and it created a $27,000 tax savings for him. And the reason is because you get a 90% tax credit on your Pennsylvania taxes. So this is a great program, especially for those individuals who are already giving money to some of these schools. So if you're giving money to any particular Pennsylvania-based school, most of the schools on the list are faith-based, but not all of them. Some of them are not faith-based schools. So, whether you're giving money to a faith-based school or you're giving money to a non-faith-based school, you want to check to see if they're on the EITC list. Because let's just assume you're giving $1,000 to ABC school, and you always give $1,000 because you went there as a kid, or possibly because one of your kids go to that school. Check to see if they're on the list. If they're on the list, you can give $10,000 to that school, and your out-of-pocket cost would only be $1,000 because you get the Pennsylvania tax credit. So it's a huge, huge benefit for folks, for taxpayers who are already giving money to some of these schools. I've had a lot of clients use this. If you have any questions on EITC, please let me know, because you might not be able to do it for 2020 because the money's probably gone for 2020, but we have some connections with some special purpose entities that have allowed some of our clients to give money to these EITC programs and to get the Pennsylvania savings and possibly the federal tax deduction. Okay, Shawn, next. Like I said earlier, I have one slide on IC DISC, and the only reason I put this up here is because I've seen some issues with some of my clients over the last couple of years with respect to these IC discs. So the main strategy for an IC disc is you have a U.S.-based company that has a lot of foreign sales. If you have a U.S.-based company that, let's assume they're a manufacturer, and their raw material that goes into their product is purchased from U.S. manufacturers or U.S. sources, if you're shipping product, you're shipping finished product overseas, and you have a significant amount of your sales going overseas, it may be of use to look at an interest charge domestic international sales corp. Basically, what an IC disc does is it allows you to pay a commission to a newly formed company, which is a company that you own. You pay a commission to that company, and then there's a safe harbor calculation that tells you how much you can pay. You pay a commission to that company turns around and issues a dividend, and as you can see, if it's a pass-through company, everything ends up back on the pass-through return. It sounds a little flaky, it sounds a little fishy, but this is exactly how the statute works. Is you pay a commission down to an IC disc turns around, pays the dividend back. The difference in the tax rate there can be as high as 17% under the right circumstances, which means you potentially have a 17% rate arbitrage, i.e. tax savings. So we've had several clients do this in the right situation, but I'll throw a couple warnings out there. First off, the savings are less if the company is eligible for Section 199A, which is the manufacturing deduction. So that needs to be considered. And like I said, it works best for pass-through entities and like partnerships or S corporations. Where the risk lies is if you're using somebody, an advisor, to monitor or run your IC disc that really doesn't understand the law, doesn't understand how they're supposed to work. We've had two pretty significant state tax bombs go off with respect to newer clients that we picked up from other CPA firms, where the IC disc for state purposes, the IC disc was a complete train wreck, because for Pennsylvania purposes, they don't recognize IC discs, and because of that, if you form an IC disc, you pay a commission to the IC disc. That IC disc is going to have to pay tax in Pennsylvania of up to 10%. Pennsylvania's tax rate is 10%. So if you form that IC disc, you could end up paying way more tax in Pennsylvania than you did before. So I've seen a couple bombs with respect to how these things are handled for state tax purposes. There are ways around that, and on the first case, we were able to find a way around that, but it wasn't easy. It was very difficult to get around that. So my strategy here is, make sure that we understand it, make sure that it makes sense, but make sure that the advisors you're using to set it up know what they're doing with respect to running the IC disc. And we've had enough experience, I think, over the last couple of years that we know how to run them. We know how to, we know where the risks are, so we're paying attention to some of that stuff. So Shawn, why don't you click to the next? I think we have a polling question. And our polling question number 1, Chris, are you still awake? There you go. How familiar are you with the PAEITC program? It's all yours, Shawn.
All right. Can everybody hear me okay? Hopefully. Good? All right. Excellent. Well, good afternoon, everyone. Thank you for your time. As Don mentioned, we're going to focus this segment on how businesses can better utilize the research and development tax credit to reduce their tax obligations. What we see is that this tax benefit is often dismissed too quickly by businesses that feel like they're not performing the types of qualifying activities that would qualify them for the R&D tax credit. there's a general misconception that unless the business has scientists and lab coats conducting experiments, or they're part of some real high-tech industry, that they're not going to qualify for this credit, or that it's not worth the effort to dig into it. And we'll kind of walk through some of the four-part test, I'll call it, is what it's called, I should say, as to what are the qualifying factors that allow taxpayers to qualify for the credit and claim the credit, and show that it's much more of a broader application than one would expect. Before I get into some of the details, I'll provide a kind of a high-level overview of what the R&D credit is, how it came to be for those that may not be as familiar with it. It's not a new concept at all. It's been around for almost 4 decades. It was originally introduced in 1981. Back then, there was some concern in the United States that we were falling behind other countries with regard to our innovation and keeping some of the technical jobs within the states, and we were losing those to other countries. So through tax legislation, we tried to incentivize businesses in the U.S. to make investment into R&D, and by doing so, allowing them to take advantage of these tax credits. It was originally introduced as temporary legislation and stayed that way for some time. It was part of extender packages every couple of years to keep kind of pushing it and re-extending it year after year until 2015. You can see with the PATH Act, it made this credit permanent, which was nice because that was one of the other hurdles. A lot of times businesses were a little bit reluctant to make the investment into doing the analysis with R&D to really, because they didn't know how long it was going to be around for. They weren't sure if at some point they were just, this tax benefit was not going to be extended, and therefore, the investment to put into it wouldn't make sense. It continues to be an area, as I mentioned in my overview, that's significantly overlooked. We have clients that have been manufacturing products for many, many years, and you wouldn't generally think of them being in the area of, industries that would qualify for R&D. However, as we walk through the 4-part test, you'll see that as they redevelop products and re-engineer or create new products, they're going to meet the criteria that allows them to take the R&D credit, even though they've essentially been operating for decades and manufacturing similar type products. Another industry in the area that's really kind of increased in popularity has to do with the brewing industry, distilleries, wineries. That's another area that one wouldn't necessarily think off the top of their head that would be a high R&D type area, but when we walk through the qualifications, you'll see that most of what they're doing to develop their product and produce their product meets this criteria, and we've really seen that as a nice area for some of our clients where they've been able to take advantage of the credit. The last area has to do with software development. I think there's a lot of businesses that are spending a significant amount of their resources in developing software for customers' use, and that's another area where these tax credits can be extremely beneficial, especially in the early years trying to develop the software they use for client purposes. This slide here is probably the most important slide I'll talk about. It is the 4-part test I mentioned. When the R&D credit was originally introduced by the IRS, as you can imagine, it provided a lot of gray area. So taxpayers were pretty aggressive in trying to take advantage of the credit. And on the flip side, IRS was aggressive in knocking down the credits that weren't substantiated properly. So over time, they developed this 4-part test that sets out the qualifications for activity, again, to qualify for a research and development tax credit. As we walk down the test, we'll see there's a lot of broad overviews of what types of activities qualify. So when we talk to our clients about identifying these issues, we're also building in our substantiation the fact that they meet these tests and so forth. The first test is permitted purpose. So what the permitted purpose basically says is that the taxpayer went into an activity that was to produce a new product or a new process or improve an existing functionality. One thing I'll mention here is that there was some confusion, or I should say early on, there was language that was called discovery language, and the concern with the taxpayers was that there was a thought that a new product or process had to be brand new to the world, basically a brand new discovery to qualify for the credit. Well, that discovery language was removed back in 2003, which allowed, basically some confirmation for taxpayers that the product or the process just has to be new to the taxpayer itself. So again, not brand new to the world, but new to the taxpayer. The second step in this qualification is that the activity was technological in nature. So it has to involve some type of hard science, being engineering, physics, computer science, chemistry. So generally, if a business has engineers on staff or computer programmers, computer scientists, and they're performing some functions, there's a good chance that these types of activities they're performing in some way could qualify for their R&D credit, depending on the type of project they're working on. The next step is that the project undertook some level of uncertainty that was eliminated. Essentially, that the know-how behind the project wasn't wide known in the industry. You couldn't have just searched on the internet or Googled it to figure out how to do something. There was a lot of uncertainty involved in the process, and the taxpayer, they had the skills and the resources to figure it out, but at the onset of the project, there was uncertainty that was accomplished. Now, lastly, that the whole process went through a process of experimentation. So there was modeling, trial and error, tinkering, if you will, to get through the process and figure out, with the new product or the process. I will add that it's not required that the project is successful. Oftentimes, that's not the case. You go through these steps, you have the criteria. However, at the end of the day, the project gets scrapped because it's not feasible. That doesn't prohibit the taxpayer from taking advantage of this credit and claiming the credit. So once you've gone through the four-part test and identified the qualifying activities, next we look at what are the expenses that qualify for the credit. The first one is by far the most significant one. It's the wages that go into the personnel that are doing the research. This involves both the direct research wages as well as anybody that's providing some support or supervision to that role. You can allocate a portion of their wages to the amount of expenditures that you're claiming a credit for. Next one's pretty straightforward. It's the supplies and materials that go into the R&D activity. You can, in addition, claim credit for if you contract out your research to a third party, although there is a limitation and a percentage limitation on how much of those expenditures the taxpayer can qualify for their tax credit. And then lastly, we're looking at if there's computers that are being rented or leased to conduct the research, those also qualify for the credit. One question that gets asked a lot is, what about overhead type costs or G&A type costs? As you can see from this list here, these are traditionally going to be just direct expenses that go with R&D. So overhead type costs generally will not qualify for the R&D credit pool. This is a short list of some types of ineligible expenses. I'm not going to go down through all of these, but I will highlight a few. I mentioned earlier that really the incentive here was to create and make the United States more competitive in that area. So to the extent activities are being conducted outside of the United States, those expenses won't qualify for the tax credit. Additionally, I mentioned software development. It is geared towards software development that is being performed ultimately for customer use. So if you're conducting any research or software development that has to do with internal use software, that generally won't qualify either. And then lastly, I'll note here that to the extent research is funded by another person or entity, that won't qualify. We have clients that oftentimes receive grants to perform certain types of research. So to the extent they're reimbursed for those types of expenditures, those won't qualify for the R&D tax credit. This next visual is just meant to kind of show you the different stages of the traditional R&D cycle. I'm not going to walk through each of these stages. This is meant more to be kind of a representation of the bookends. So basically from stage one to when the idea or the project's created through the point when the project is gone to commercialization and is being produced. Generally at that point is when the R&D activities have ceased. That doesn't mean that a product can't go back into the R&D cycle. So there's can certainly be situations where products are being produced, but for some reason there's a need to re-engineer it or fix a defect or something of that nature. In that situation, the project is back into the R&D cycle and so forth. just quickly want to touch on a couple of different methods of calculating the credit. I'm not going to go into the gory details because I don't think anybody wants to hear those, but the first method that's been around as the most long established method can provide the highest credit for the right type of industry. However, there's a lot of limitations with the first method, the regular research credit, because it does look at the taxpayer's gross receipts compared to their qualified research expenses. So this was a hurdle for some time for taxpayers that had a significant amount of gross receipts, but not a significant amount of qualified research expenses. It limited their ability to claim the credit. In 2006, the alternative simplified credit was introduced, which really opened up the door for a lot more taxpayers to get over that hurdle. It doesn't look at gross receipts, it only looks at your qualified research expenses and allows you to essentially calculate the credit under two different methods. One is where you go back and do a multi-year analysis where you build a 3-year base, and this allows you to have a higher 14% tax credit on your qualified research expenses. The other option is just to look at your current year activity, but as you can see, there's only a 6% credit allowed on those types of expenses. Just to show you kind of mechanically how that works, it's pretty straightforward. Under the example where you don't have any prior year expenses, in this situation, if you have $100,000 of identified qualified research expenses, work right down through the calculation, the taxpayer in this situation receives a $6,000 tax credit. Again, this is a tax credit on on expenditures that were already made. So when we talk about trying to take advantage of this credit, it's a credit for, it doesn't require additional expenses to go out the door to get the credit. In the second example, it shows the same level of qualified research expenses in the last example, although this one includes the multi-year analysis where we went back and looked at the prior 3 years and build a base period. So by doing that, in this example, there was $120,000 over 3 years incurred for qualified research expenses. You work through the mechanics, which is essentially half of your base year average. That's a $20,000 base period. So the increased amount of QREs was $80,000, but because you can have a 14% credit due to the prior year base period, it allows you to almost double your credit. So instead of only receiving $6,000, the credit's up to $11,200. So oftentimes we do find it is worthwhile for taxpayers if they're going to go back and they have the ability to look at prior year information and gather that information to go back and do a multi-year analysis. And just this example just demonstrates how that can be more beneficial. The last thing I just wanted to touch on is just provide a brief update on some of the recent developments with R&D credit. I already mentioned the 2015 PATH Act made the credit permanent, which was significant. The other significant development there was that it provided an ability for small businesses and startup companies to make an election to apply the R&D credit to their payroll, to the employer's share of the payroll cost. This was pretty significant because prior to that, startup companies really can benefit as quickly from the R&D credit because they weren't having, they wouldn't have income in their first few years of development, therefore they wouldn't have tax liabilities to offset. What this change allowed was the ability for them to immediately start to offset those payroll costs from the employer's perspective and turn those tax credits into true cash flow savings. The 2017 Tax Cuts and Jobs Act, there was a reduction to the corporate tax rate that indirectly reduced the amount of the benefit that was being lost on claiming the credit. The corporate tax rate was reduced from 35% to 21%. When you claim the credit, you're required to add back that amount to reduce your deductions by that amount. So indirectly, instead of only losing a 35% benefit, you're losing a 21% benefit. So that indirectly benefited taxpayers by that change. And then lastly, with the CARES Act this year, there was, I mentioned earlier, the ability to offset payroll taxes for startup businesses. Well, the CARES Act allowed the ability for payroll taxes to be deferred from 2020 into 2021 and 2022. There was some question whether the ability to still offset those deferred taxes with the R&D credit would be an option, and through the IRS frequently asked questions, they confirmed that even if you defer your payroll taxes, that the credits will be available to offset those when they come due. So that was clarified there. And then lastly, the CARES Act allowed for NOLs to be carried back for businesses up to 5 years, which I think Don and Ryan probably touched on earlier. What we've seen is that's gone back and offset taxes that were previously used to or offset by the R&D tax credit, and now those credits are carrying forward under the current carry forward period, which is 20 years. So with that, I'll conclude my session. I just again want to highlight the fact and encourage everybody on this webinar to take a critical look at the types of activities that you're performing, see how they meet those 4-part test criteria. And if you have any questions or want to have further discussion, feel free to reach out to me or your GYF representative. And I will, with that, turn it back to Don.
Thank you, Shawn. Shawn, since our session is called Strategies, Opportunities, and Risks, give us some of the risks that you see with R&D.
Sure. Well, I guess I'll approach it from 2 perspectives. The one's the risk of the opportunity cost. So I mentioned in the introduction, a lot of taxpayers feel like they're not doing the type of activity, or they're not that sophisticated type of industry, so they don't even look at it, or they're afraid to make the investment into it. So we see a lot of risk from the perspective of people not taking advantage of this tax credit. Again, it is a credit for expenses that have already been made, so you're leaving essentially tax dollars on the table by not exploring this type of tax credit. So that's I guess the opportunity cost risk. The other risk is taxpayers that don't necessarily take it, I won't say take it seriously, but don't go through the proper steps of properly documenting the research and development and so forth. This is one concern that you hear a lot is that I'm going to get audited if I try to claim the R&D tax credit. That's not necessarily the case. It doesn't trigger an audit, but what I will say is when you are examined by the IRS, if there is an R&D credit on your return, it will be looked at. It's called a Tier 1 audit item, so it's something that gets looked at. And as with anything else, to the extent that that credit's been documented and the substantiation's in place, we haven't had any issues with that in the past. But there are risks there if you don't go through the proper steps and just try to take estimated cost on there or do something of that nature. That can be a risk of not taking it seriously enough.
And then just one more question, Shawn. You said that if it's audited, you've had clients that take the R&D credit. Have you had any specific issues or big audit changes with respect to R&D?
I have not. Generally, I've talked to examiners throughout the process, and again, we go through, we check the boxes. We have our questionnaires in place and everything, which that's really the biggest part of the process is, when you have an IRS auditor come in and you show that you've already gone through those steps and you have the substantiation, you get the IRS auditor on board with you fairly quickly, and they know you've gone through and you've taken it seriously enough. They're less inclined to kind of really pick at the numbers and so forth. Much different than if you don't have that in place. It's going to open up the risk there that they can really start to dig in. And probably what's going to happen in that situation is they're going to bring in an R&D expert from the IRS, because most agents aren't sophisticated enough or I shouldn't say sophisticated enough, but aren't experts in that area. So they're going to come in. I see how you caught yourself there. They're going to come in and bring in an expert in that area, which I know I don't want to be in that situation. I know enough about it, but I'm not an expert to a lot of the degrees of these examiners in the IRS, and that's where I think things could get real ugly if that happens.
Very good. Enough said, as my son would say. Thank you, sir. Let's move to the polling question.
All right. Very good.
So this question specifically addresses R&D tax credits. Question, do you feel your organization is conducting qualified research activities that may qualify for R&D tax credits? We are already claiming the credit. Yes, I think we could qualify for tax credits. Maybe I think we should review more closely. No, I don't think we would qualify. So we'll let the question be answered, let everybody respond. We're going to change our speakers. And while Shawn is changing with David Kerin, just introduce David Kerin. David Kerin is a senior tax associate in our tax services group. David spends quite a bit of time working on clients that that utilize what we'll call community development tax incentives. I'll let him talk about 2 of those incentives that he's worked on over the last several years with several of our clients. Welcome, David. Good afternoon. Thank you for speaking.
Absolutely. Good afternoon, Don, and good afternoon, everyone. Thank you for your time. As Don had said, I'm going to be talking about community development tax incentives, and I'm going to be talking about 3 different ones. The Opportunity Zone program and the Historic Tax Credit program are 2 of them that are designed to revitalize communities. And the last one is a energy efficiency program called Section 179D for commercial and residential properties. So first, we're going to jump into the Opportunity Zone program. And to understand the Opportunity Zone program, we first have to know what, where, and who can participate in the program. So what is the goal of the program? The program rewards long-term investments in distressed or low-income communities. And these, I want to stress the long-term portion of this, because as you'll see when we go through the incentives, almost all the incentives are linked to the time the taxpayer holds the investment. So if we understand that, we know why the incentives are how they're set up. I've also included a link. If you click that link down below, it'll take you to a listing of the tracts, as well as an interactive map if you're just looking at any properties or businesses you have that might already be situated in an Opportunity Zone. And next is who can participate in the program. And it's a very broad program. Almost any taxpayer, including individuals, pass-through, such as partnerships or S corporations, C corporations, trusts. Really, it is almost any taxpayer that recognizes a capital gain for federal tax purposes. So getting into what I call the life cycle of the Opportunity Zone program, it involves 3 steps, and each step has a tax benefit associated with it. Our first step is entering the Opportunity Fund. So a taxpayer has to recognize a gain and roll that gain forward within 180 days into an Opportunity Fund. And that capital gain can be any capital gain, short-term, long-term, directly incurred by the taxpayer or passed through to them from partnership or S corporation, for example. And when they pass that through to the Opportunity Fund, they trigger the first benefit, which is a deferral until 2026 of paying the tax on that. And we'll get to an example that'll walk us through each of these 3 steps so we can put numbers to them. And next is our step 2, which is really just hold the investment. And while you're holding the investment in the Opportunity Fund, the Opportunity Zone is going out and investing in Opportunity Zone businesses or Opportunity Zone property. And there are several restrictions related to those businesses and property, but generally for this presentation, let's just think it is any property or business that's generating their income inside the Opportunity Zone. And this is where we get to our first 2 time-based incentives. One is at 5 years of holding your investment in the fund, and you get a 10% basis step up, meaning on the deferred gain, which means that you can reduce the taxable portion of the gain that you'll pay in 2026 by 10%. Second is a 7-year period where you get an additional 5%, and that again applies to the deferred gain. So you have an option to reduce your deferred gain by 15%, where you only pay tax on 85% of the gain in 2026. Now, one thing I want to note, if you're not already in the program, since we have to recognize that gain in 2026, the 7-year holding period is passed, but you are still eligible for the 5-year period, which is the 10% step up, as long as you get into the fund by December of 2021. Lastly is exiting the fund, and this is where we have the biggest potential tax benefit. If you exit the fund and have held your investment in the fund for at least 10 years, then you are able to exclude the entire appreciation of the fund. For example, if you had a $100,000 gain that you rolled forward into the Opportunity Fund, and in 10 plus years, that fund is worth $1 million, you can exclude $900,000 of capital gain, just completely tax-free. So this is where there is a lot of opportunity. So as I said, I want to run through a quick example just to put numbers and see how the steps work. So we're going to assume that I have a $100,000 capital gain I incurred today. And just to make the math easy, we'll say a 20% tax rate on that capital gain. So today, capital gain of $100,000, and I roll that forward into an opportunity fund. I trigger my first benefit, which is I can defer the tax. Instead of paying it in 2020, I can pay it in 2026 when I file the 2026 return. Step two is just holding the fund. So let's fast forward, jump ahead in time to 2026. That gain is now taxable. However, I've held it for 5 years, so I get a 10% basis increase, which reduces my gain from $100,000 to $90,000, or saves me $2,000 in tax. Let's jump forward again a few more years. The same set of facts. I've now held my investment for 10 years in the opportunity fund, and let's say it's worth $200,000, so my investment has doubled in that 10-year period. If I've met all the regulations, I'm able to exclude the entire gain when I sell the fund. So instead of paying tax on another $100,000 gain, it's completely tax-free. So that saves me $22,000 of tax over this Opportunity Zone program versus just a typical investment. I do want to talk about just a couple of the risks here. It all sounds great from a tax standpoint, but there are some economic risks we need to consider. The first being, we can't just choose an Opportunity Zone incentive for the tax benefits. If we want to make an investment, we have to be sure that it's a good investment. Like I said, the biggest potential is on the back end, where you have the appreciation of the investment. So if you don't have that appreciation and there's other investments that are a better value or a better rate of return, you have to be sure that you're considering those as part of the cost of going into the Opportunity Zone program. The second, and this has become even more important lately, is a change in tax rate. Going back to that same example of $100,000 at a 20% rate, say I make an investment that never takes off and is just, even I just get my money back. If I were to defer the gains and the tax rates were to increase from 20% to 40%, I deferred a gain at 20% for 5 or 6 years, and now I'm paying tax on it in 2026 at 40%. And I think that's a really good point we need to consider. Now, it's also important to note that if we were to get the appreciation on the investment, like I said in the example, then we'd also be saving the 40% rate. However, with a bad investment and an increase in rates, you could be kind of whipsawed and have a double negative there. So moving forward to the Pennsylvania Historic Tax Credit Program. It's a tax program ran by the Internal Revenue Service as well as the National Park Service. And the goal of the program is to provide an incentive to save and reuse or repurpose historic buildings. And they define historic buildings as anything that's already been certified as a historic structure or provides a historic significance to a district. And it doesn't have to be certified at the time of the investment. Part of the program is working with the National Park Service to make sure that they agree that this building is in fact historic. So you can have up to a 20% credit of what are called qualified rehabilitation expenditures. I'll refer them to QREs. So for example, if you have $1 million of QREs, you're able to generate a $200,000 benefit right off the bat. So again, what are QREs? We have to think about back to what is the goal of the program, which is to reuse and repurpose and rehabilitate these historic structures. So they want them to be capitalized expenditures that you're repurposing or reusing the building, but keeping its historic nature. So that can mean hard costs such as building envelope, HVAC, electric, carpeting, flooring. There's a whole slew of items there, or even soft costs such as development fees, engineering fees, even accounting fees when you're looking at working with the program. Now, there are some costs that don't qualify, and those costs just generally are costs that don't keep the building in line with its original purpose or its historic purpose. So enlarging the building, acquiring the building, putting furniture, computers, or fixtures in the building, none of those really bring it back to its historic structure. I will say we do see some interesting things with this program. A lot of times the National Park Service will come in and say, well, part of what makes this building historic or unique is this staircase. Well, that staircase may no longer be viable, or even it could be a safety issue. So what happens is they have to keep it and reuse it, but it ends up being blocked off. So there are some interesting things you run into, and the National Park Service will work with you to make sure that you truly understand, as will your architects or engineers. So utilizing the credit has changed. If you've done this in the past before the Tax Cuts and Jobs Act, you used to get the 20% credit right away. So right in the year the building was placed in service or ready for use. And now you have to take it over a 5-year period. So it does delay the value of the 20% credit a little bit, but still you're getting a 20% credit on rehabbing a building you might have had your eye on anyway. Additionally, there are many states, including Pennsylvania, that also provide benefits for this historic tax credit program. So if you think you qualify for federal, it's best to check your state. In Pennsylvania, you're allowed a credit of up to $500,000. You do have to be sure to make sure you apply for them early. They go quick. There's only a limited amount. Moving forward to our final topic, the Section 179D energy incentive. The properties that qualify for this are commercial properties or residential properties that are taller than 4 stories. So what they're looking at is that you're not just taking a single family home and making it more energy efficient. And you have to meet certain energy standards, and the deduction is up to $1.80 per square foot. So the bigger the project, the bigger the deduction you will get. We've seen deductions anywhere from $200,000 to $300,000 is pretty typical for this incentive. It does expire at the end of 2020, but it's still important because this credit has expired multiple times in the past, and we continue to see it reinstated, whether it's before it expires or even after it expires retroactively. So if you think you've made energy improvements to the building envelope, windows, doors, or HVAC and even lighting, it's important to just ask the question to see if your building might qualify. And that'll push us through to our final polling question, and then our final speaker, Mike Weber, is going to talk to us about some sales tax issues. I know we covered a lot of topics very quickly. If you have any questions, my contact information is in the slide, and I'd be happy to talk to you. Thanks, guys.
So our polling question here is talking about the ability to invest in an opportunity zone. And what I would say, and I think David covered it in a great way, I think it was very well done. These things were really hot three years ago when they first came out. We heard a lot of information in Pittsburgh about how these were going to be really, really important. They are still very important. We just haven't had, we haven't seen them utilized as we thought when they first came out. I'm not sure what the reason is. We have had some clients invest in opportunity zones, but they certainly haven't been as hot as we thought they would be, and we're not really sure why. So Mike, you can go ahead and step forward and skip past the polling question. So Mike's going to spend just a couple minutes, because we only have a couple minutes left, talking about some sales tax related issues that he's dealt with. Mike does a lot of work on sales tax. Mike is an attorney and a CPA, tax senior manager in a group. Thank you, Mike. It's all yours.
Okay, thanks, Don. I know we only have a couple minutes on this hot topic, but of course, you know, in prior webinars and presentations, I've talked about Wayfair, and while that still remains an important issue, we're not going to go through all the details with respect to that case, but understand now that if you're conducting your operations across state lines by virtue of the internet, selling your product, shipping it everywhere, you now, dating back to just a couple years ago, you now can potentially be subject to the charging sales tax in other jurisdictions. Now, why is that important? In every transaction that I've encountered throughout the last 2 years, and even prior to that, sales tax becomes a humongous issue. The buyer is always asking, okay, what obligations am I walking into potentially? And they want to know what your footprint is and what you've done with respect to sales tax. And so if you've done nothing, then of course you're going to have to escrow the amount and go through what I have listed here, a VDA process, which is just a 3 or 4 year look back with respect to every state. And once you do that, they'll give you a clean bill of health for any, prior year. So, but that takes a tremendous amount of time. I still have one going on. I think we're in our 3rd year with the Commonwealth of Virginia, and we still are not able to get that cleared up. So, just stressing the importance of compliance here. Just remember, it's not your tax. You're just collecting it on behalf of the state in which you're operating. And also with respect to these transactions, if you're not collecting the tax, it can hold up the deal. And of course, you, as the seller, you want that money as fast as possible. So it's important to become compliant as quickly as possible. I've got a couple of, just with respect to Pennsylvania, and there are other exemptions out there, and other states may have different rules, but these are some of the common exemptions that we see, in the sales tax community. So if you're conducting yourself in one of these areas, it's entirely possible that the products you're buying that go into your product or the items that you're selling may in fact not be subject to sales tax. So, again, it's something that everybody really needs to look at. And if you're operating one of these industries, you probably know the rules, and you probably know all the rules, or you think you at least know all the rules, and you're following what you think are the correct answers. But if you're selling to somebody in one of these industries, you may not know all of the rules. So if you're doing that, what should you be looking at? Well, there are exemption certificates that should be produced by the buyer, and you could accept those in good faith as the seller, and you don't have to charge sales tax. This is probably one of the areas where I get the most questions right now is, okay, which exemption should I be accepting, if any, and what exposure do I have if I'm accepting a certificate that's not accepted, in good faith? Well, if you're not accepting it in good faith, of course, you should recognize that you have a lot of risk there, right? And so if the state comes in and audits, either party, they can come after both parties to collect the applicable sales tax. Another big issue that I get is, or question that I get is, in the exemption area, how long is an exemption certificate good for? Well, in PA, the blanket exemption certificate's good for forever. Now, that doesn't mean you shouldn't be reanalyzing this situation on a year-to-year or maybe every other year basis, but other states may have different rules or timelines on that, perhaps 2, 3, 4 years. If you find that you've made a mistake, you can apply for a refund in this area, and that can be a little bit of a convoluted process depending on exactly the circumstances surrounding the refund. So if you have any questions on that, you can feel free to reach out to myself or anybody on our tax team. So Dawn, I don't know if you have any questions on that. I know it was a short discussion on sales tax, but that's what I have in this area for today.
Mike, I have one question, and my question is, have you seen an uptick with respect to sales tax audits as a result of Wayfair?
At this time, no, I have not seen that, although I suspect that, given the deficits that a lot of these states are facing in the short and long term, that this is an area that they're going to be aggressive on in the very near future. So, it does make sense, again, if you're selling your product through the internet, that you reanalyze what you're doing here and making sure that you are charging sales tax when you're required to do so, and conversely, not charging sales tax when you're not required to do so, because of course that can be a competitive disadvantage to you.
Excellent, thank you. Well, I want to thank everybody for attending. Last time I looked, we still have 299 participants. So thank you for everybody for sticking through. I think the high watermark was around 325 roughly today for our 2-hour session. So we want to thank you. We sincerely appreciate you attending. We sincerely appreciate your referrals and your business. Thank you to our clients. Thank you to our families. Of the 300 people, I know we had at least 17 former GYF employees, alum, who were participating. I know we had parents of one of our employees participating. I had a sister-in-law participating. We had over 100 clients participating, and obviously a couple hundred contacts. So thank you for the service. Thank you for the referrals. We appreciate it. And please feel free to reach out to us if you have any questions. We covered a lot of area over the last 2 hours. We easily could have spoken for 2 days on some of this stuff. So thank you for everything. Thank you for your attendance, and have a safe, happy holiday, safe, happy Thanksgiving, and we'll see you out there soon. And wear your mask. Take care, everybody.